Good morning, everyone. This is Ben Ryan, and welcome to the Hedgeye Morning Macro Call for Tuesday, November 18th, 2014. Before I hand it over here to Keith, I'll touch on our asset allocation, which is unchanged from yesterday. Currently sitting at 67% cash, 29% fixed income, 4% foreign currency, commodity, international equity, and U.S. equity exposures all held flat at 0%. Go ahead, Keith.
Thanks, Ben. Top three things in my notebook this morning in the world is number one, the Japanese yen. Number two, all of Europe. And number three, the Russell 2000. So first on the Japanese yen, you have to follow the bouncing ball here. GDP obviously surprises to the downside yesterday. Economic reality bites. Nikkei goes down, and then they come up with the next central plan this morning. And people who look at the chart of the Nikkei, much like looking at the chart of the Weimar Republic stock market in 1924, says, I want more of that. So again, the Japanese are looking for a snap election on December the 14th. My question to you, if you're along the Nikkei, what happens if he loses the election? Net, you look at this within the prism that is the risk range of the Japanese yen. The downside risk to the range now is 114.04, with immediate term oversold for the Japanese yen. Again, looking at it versus the dollar at 116.97. So it's a very interesting spot, if only because the Japanese yen have been completely burnt to a crisp. All correlation risks in markets have gone berserk on that. And if you tap the top end or the low end, however you look at it upside down on the end of the range, what happens next, Mr. Abe? That'll be a question that the market will have to answer tomorrow morning. Looking at Europe across the board, again, you get one of these many bounces we've had. We've had short selling opportunities in European equities, for 3 months? And again, the central plan is not working. What you're getting more of is deflation. So again, on the bounces, our two preferred short selling opportunities are in France and Italy. So EWI and EWQ are the ETFs on that. No, we don't have positions on in real-time alerts currently, but we are looking forward to putting those shorts back on, indeed, this morning. Now, again, looking at the Russell 2000, something not so funny happened on the way to the storytelling forum. Everyone's navel-gazing at the Dow. The S&P doesn't go down. But guess what? The Russell 2000 is down almost 2% in the last 3 trading days. Now, for those of you who've been following this closely, you know that we do not like the Russell 2000. It's flat for the year to date, which stands in stark contrast to something like TLT, which is a long bond, which is up about 18% for the year. Now, again, breaking down in the face of the S&P not going down is called a negative divergence. So again, if you're looking at downside support right now for the Russell, there is none to really 1148, and actually all the way down, if that breaks, to 1005. Which is, again, where we saw in October, and very few were positioned for that. So those are your top 3 things. Now, because we're on the morning show this morning, I'm just going to give you, again, around the world, through the grind, giving you risk ranges, trend levels, again, trend views, research views, and a bit of ranting in between. Looking at the S&P 500's risk range, 1998 is immediate term trade support, whereas resistance is 2047. So again, we're at the all-time highs in the S&P 500. Very few people think it can go down ever again. And again, if you look at the complexion of that, what's actually happening underneath the hood is that volume is decelerating on the up moves. So again, if you look at yesterday's total U.S. equity market volume on a 1 month versus the 1 month average, get this, total U.S. equity market volume was down. I got to giggle because it's just ridiculous. I mean, versus the 1 month average, total U.S. equity market volume is down 26%. Versus the year-to-date average, it's down 46%. So do you hear crickets in the S&P futures pits? Again, I don't use the S&P futures. I don't use the index. I am not short the SPY for this reason, because 14,000 hedge funds are still trying to cover it at the same time. So go back to the Russell. The Russell's risk range is 1148 to 1187. Again, sell at the high end of the range, cover at the low end of the range, and like it. Looking at underneath the hood below volume and volatility trends, again, volatility continues to break out on an implied basis. Now, again, it would have to break 1134 on the front month VIX to change that. A moving monkey would tell you, what is he talking about? Why is he so bearish? You know, it's like, again, if you just look at charts and you don't look at volume and volatility, I mean, everything looks fantastic, doesn't it? I mean, at the end of the day, again, volume and volatility matters. If you don't believe that, get yourself into a body of water that is approaching a waterfall. And again, you might just think that the level of water is fine. But again, by the time you hit the point of entropy, big word, you hit the over the waterfall point, you might look back and say, wow, the volume and the velocity of that water was moving pretty quickly in hindsight. So again, that's how we think about it. And again, we're not going to change that this morning. The risk range for the VIX, if you're looking at front month VIX, is 12.53 to 16 spot 01. So again, the VIX can go to 16, then it can go to 28. And again, what we would anticipate seeing happening, much like we did in early October, and it might happen in early December, is that risk happens slowly and then all at once. So again, looking at that for what it is. If you look at the sector components within the S&P 500, if you're still playing the deflation call, which is ours, again, deflation in energy stocks, again, yesterday, down another 0.5% on the day for the XLE versus utilities, which is pure, outright, unadulterated yield chasing, up 1.3% for you if you're along the XLU. So again, if you're long XLU, you're up 19.9% for the year to date. If you're long energy, XLE, you're down 3.1% year to date. The divergences at the sector level are manifest. Again, these are manifest because growth's slowing. Both growth and inflation expectations are slowing globally, and that's how we think about it. We think about sector setups. We don't think about navel gazing at the Dow Jones Industrial Index. Now, looking abroad, again, broadening your horizons to Asia. Now, some people will say green arrows. I mean, what the hell, by the way, is a green arrow? Is that what happens when you wake up in the morning and you like pull up your screen and you see that the Nikkei was up? Well, the Nikkei was up, but guess what? China was down for the 4th consecutive day. The Hang Seng was down 1.1%, and Indonesia raised interest rates. Say what? You know, it's like you got all this stuff going on. Not to bother you with it. The rest of the world, if you ask anybody who's navel gazing, doesn't really exist anyway. But again, I love what the Indonesians did this morning, by the way, because they're doing what the Indians did. They're doing what I think America should do, which is protect the purchasing power of people. This is, of course, not what Japan is doing, which is devaluing the currency and burning the people's currency or purchasing power at the stake. But again, Indonesia raises interest rates, and the market doesn't go down on that. Much like India, they've raised interest rates. Markets go up, growth expectations go up. People have to sell bonds and invest in growth. Imagine these things. I tell you, the history of it all could drive you right crazy. Europe across the board, they're not going to do any of that. They're not going to raise rates. They're going to act like the Japanese are, and then the U.S. is going to act like the Japanese and Europeans are. So again, this is what they're doing. And until it fails, guess what? They're going to keep doing it. So again, all I care about is the risk range on these levels. So again, the DAX, the CAC, and the MIB, which are again Germany, France, and Italy, have immediate term trade over bot signals pending, which will provide you in real-time alerts today. I'm most likely going to go to the most socialist place because I like to short France. And again, we've shorted France multiple times this year and made people money doing it. So again, looking forward to that signal in EWQ terms, which is, of course, French equities. Now, if you want the real juice in Europe this morning, of course, you'd have to be long something like Greece. Again, you know, it's just greasy. You see the markets up, the green arrows and all that stuff. But the biggest movers are the biggest crashers. I mean, Greece, by the way, is down like 25% for the year to date, but it's up 2 this morning. Golf clap for that. Commodities across the board, if you look at deflation, it is, again, manifest. So you're going to get a short selling opportunity in gold. Did I say gold? Yes, gold. You know, gold could be a short selling opportunity if it holds up at this level. So again, think of how we think about risk, which is you want to sell at the top end of the range and you want to cover at the low end of the range. The current top end of the range for gold is right around 1203 to 1205. So when it's at that level, you don't buy. And the low end of the range is 1130. So again, there's a big wide open mouth to the downside in deflation expectations. That does include oil, obviously. It includes gold. We're still short copper in real-time alerts. So again, today would be a great short selling opportunity, not only in socialist equities like France, but also in commodities. So again, that's how we're going to play global growth in terms of expectations on growth slowing and on the deflation side. So there's a lot to do on the short side this morning. 10-year bond yield, just because you care, because you're along the TLT and loving it this year. Again, the 10-year risk range is 2.29% to 2.35%. So if you see 2.35% on the 10-year, you buy the TLT. Again, I think we've said that every day this single year. Again, if you look at currency markets, interesting setups. Again, the euro's having a good move to the upside this morning. Again, this is the biggest short position in the hedge fund community currently. You have over 162,000 net short contracts. And again, we look at this on a non-commercial basis. So again, we try to capture what hedge funds are doing. And guess what? The consensus of hedge funds, if you do the complete opposite, and you've been doing that, whether it be in treasuries, in the yen, in the euro, in oil. If you've only done the opposite of where the net position is, it could be long or it could be short, you have crushed it for 2 years. So again, look at that for what it is. The euro bears are getting squeezed this morning, but the risk range in the euro is 123 to 125. So again, if you're getting squeezed, I wouldn't cover it at 125. I'd probably short more. Economic data points away from that. The UK didn't have any inflation to speak of in the CPI report. It was dead flat with last month. Again, don't worry about these types of things until you have to worry. And again, the UK has had very good economic data, but now they have very difficult comparisons in the data. So in other words, they're going to start to see growth slow in rate of change terms and inflation start to fall in absolute terms and rate of change terms as well. So again, these are just alongside the many and manifest, word of the day, manifest, global growth and inflation expectations slowing. And I guess that's a good spot to take some questions.
All right, Keith, thanks. We have a good stream of questions here. First one, back to the point on observing sentiment, changes in sentiment on the buy side. You've been on the road a lot lately. What has sentiment been like?
I've been on the road too much, Mr. Ryan, too much. Yesterday I was in Tampa. Well, sentiment is this. The market doesn't go down, so I can't be bearish on the market. And typical, I'm talking about equity investors. If you, God forbid, you meet with somebody who runs fixed income money or somebody who runs a multi-strategy hedge fund that has fixed income, currency, commodity books, I mean, their world is very different. So again, their world is in shambles. Imagine if you're running levered long commodities. You're getting your rear end handed to you. If you're looking at fixed income volatility in junk and high yield, just one of the worst weeks of the year was just last week. So again, you follow the bouncing ball of risk. Commodity deflation takes out energy, small cap equities, and then it goes to the bond market and says, hey, what say you about these cash flow streams on these interest payments that you need to pay? And I think that real constipation out there is I'd say drastically different. If I sit down with a mutual fund, long only USA portfolio manager, it's almost like they're looking at me like I have 5 heads because I just quoted the weather that was occurring outside that they could evidently see themselves if they were to open their eyes to it. So again, the complacency on the equity side, particularly when it comes to saying something like the Dow or the S&P, God forbid you looked underneath the hood and looked at the Russell. But again, the complacency is huge in as much as it was in equities at the end of September. And unlike the end of September, you already have, like I said, the interconnected risk of fixed income commodities and really debt markets on the high yield side doing a lot of things that hadn't been happening in September. So I'd say it's a very risky world relative to the last tick in the S&P futures.
Right. So question on the S&P futures, since they can't go down. Can the Fed buy SPOOs and sell VIX forever? Capital limits or print until they own the market, a la Japan and BOJ and JGBs?
Well, I laugh at that question. The question again is, can the Fed buy SPOOs and short volatility in perpetuity? Now, of course, the Fed doesn't do that. Some might have a conspiracy theory that they're actually doing that specifically. But what they're really doing is that they're getting 11, 10, 1,000 hedge funds, however many funds you want to think about, behaving that way. I mean, think about how many hedge funds are horrendous on the short side that have to use the S&P futures as their quote-unquote hedge. So then they could tell people, look, I'm hedged. But they're all hedged with the same damn thing. So what they're really being infused with is emotion, because the Federal Reserve continues to wake them up to the reality that they might have to cover their shorts. Now, what I'd like to see is, much like at the end of September, the S&P index and E-mini position, again, looking at futures and options contracts, went to a net long position. We're knocking on that door right now. There was a net short position through October. Again, hedge funds short low and they cover high. And now they're all covering high, and volume is starting to decelerate in the total cash market. And that's, again, it's just a clean-cut sell signal. I probably sound as crazy today telling you to sell on November the 18th as I told you to sell beta, again, U.S. equity beta, on the 18th of September. But again, maybe I'm a crazy guy. Maybe I'm not. Maybe I'm just doing what everybody else isn't doing, which is, again, being a monkey, just being net long always the S&P futures at any price.
Okay. Question on volume here. Historically, down volume is always higher than up volume. Up volume decelerated during the entire up move from the 2009 lows. Why does it matter now then?
The 2009 low, this is very different. I mean, I mark this down in my notebook every single day. What actually happened from the 2009 lows was that the bounces came on accelerating volume. So again, this is why we got bullish in 2009 on the U.S. equity market. So again, very basic setup for those of you that care on our process. There's 3 factors. There's price, volume, and volatility. In 2009, what was happening at the end of it, again, think about it in terms of a waterfall. So again, the waterfall risk occurs. Everybody's flat on their back at the bottom of whatever that base of water is. Volatility basically starts to get smushed, and volume starts to accelerate on the up moves. So that's exactly what happened in 2009. That's why we got bullish. Price up, volume up, and volatility start to go down. Again, because you're already over the waterfall, so the point of entropy is backwards, not forwards. Fast forward to today, and you have price going up with volume going down and implied volatility rising. So again, that's telling you that there's a waterfall coming. Now, you can sit there and say that you didn't see it happen in October, but I can guarantee you, if you were running levered long on October the 1st, you were definitely feeling some version of that between October the 10th and the 15th. So again, very different setup than 2009. And again, we had a very different view in 2009 than we have today.
Great, thanks. This kind of a question on our process and how we can kind of communicate it. Always worth communicated a little bit better. Where do you find your short position in IWM among your asset allocation chart?
Well, asset allocation, again, we express it how I would express my personal account, which is, again, if you go to the high net brokerage network of Old Wall, you're not going to see asset allocation like this. Because number one, they didn't run a hedge fund, so they don't think of asset allocation on a net basis. So when I have net zero asset allocation, that means that I am beta adjusted net neutral to that asset class. That means I have no net exposure. So again, I can be long 100 million worth of X, and I could be short 90 million worth of Y, and you'd say that's net long. No, it's not if the betas are set up in a way that they're net neutral. So again, the way that I think about IWM is that's how I get myself neutral. So again, when I think about the S&P 500 or the U.S. equity allocation, I'd be net long, so certain subsectors like utilities, REITs, consumer staples, and healthcare, we've liked them all year, and I'd be short IWM, energy, XOP, etc. So again, that's how you set yourself up. You have longs, you have shorts, they net to zero, and that's why I don't have a net long position to lean on. Whereas fixed income, I have a net long position that's explicit. You could see it right there. It's almost 85% of our max asset allocation to any asset class. So again, that means that it'd be way longer than I am on the short side in terms of fixed income. Again, if I were to set up a hedge fund and had one, or I'm advising on many at this point, I mean, what I'd have is I'd be long the long bond and I'd be short junk. So again, I'd still be net long big time because I have a much higher conviction in treasuries going up than I do junk going down. But that's how I'd set it up, longs versus shorts. So it's a net position by asset class, and that's how we think about the risk management.
That's good. That's easy to understand. I'll group. We don't create price targets, but I think we can group these two questions together. Where can oil prices go this winter? And then from another question coming in, I'm getting a target for the long bond under 2%. Does that seem possible?
Well, the second question first, absolutely. I mean, the 1.7% we would deem probable on the 10-year bond yield within the next 3 to 6 months. So when I say that, it's not like I lick my finger and say how it feels, and I don't like to use 2 just because it's a big round number. What I'll do is I'll pull out the duration. I'll say, if my duration, if the question is over the intermediate term trend, so 3 months or more, we call that trend, what is the probabilistic range of the 10-year bond yield? And it's currently 1.7% to 2.6 or 2.7%. That's your range. So again, it's within the probable range. So absolutely 2 is still within that range, and you can see it. Now on oil, actually, it's the same way to answer the question. We don't lick our finger. We don't call somebody and get a survey. We don't, feel anything about this. We look at the risk range. So I look at WTI like we did at the beginning of October, and the regime change in WTI, or olive oil for that matter, if you look at Brent, it's the same thing, went from a bullish trend to a bearish trend. It's called a phase transition, when something from a long period of time goes from bullish to bearish. And then I start to model on a 3 to 6 month basis what the probable range is for the price of oil, and it's currently basically setting up between 64 and 84. So what it's actually doing, if you follow me closely, is that it's giving me lower highs every week and lower lows every week. So again, phase transition is basically rolling over to delta negative or delta bearish, and what you have is lower highs and lower lows. And again, I wouldn't consider it improbable to see oil with a 6 handle in front of it within 3 to 6 months.
All right, great. We'll wrap it up there. Thanks for tuning in, everyone. Good luck out there today, and we'll catch you back here tomorrow, same time. Thanks.